Have you ever wondered why so many people, maybe even you, end up losing money in the stock market or other investments? It feels like a rigged game sometimes, doesn't it? Well, today, we're pulling back the curtain on the most common reasons people lose money investing. And trust me, it's not because they're unlucky. This is part one of our series, so let's dive right into the first major pitfall. It's a lack of knowledge. Imagine trying to fly a plane without ever taking a lesson. Sounds crazy, right? But that's what so many people do with their hard-earned money. They jump into investing without understanding the basics of the asset they're buying, the company behind the stock, or even how the market generally works. They might hear a tip from a friend or see something online and just throw money at it. This isn't investing, it's gambling. When you don't understand what you own, you can't tell if it's a good price, you won't know when to sell, and you're taking on massive, unnecessary risk. The first rule of successful investing, made famous by Warren Buffett, is to never invest in a business you cannot understand. Before you put a single dollar into anything, take the time to learn about it. What does the company do? How does it make money? Who are its competitors? Is it profitable? Answering these simple questions can save you a fortune. Next up, and this one is a huge one, is emotional investing. Our brains are wired for survival, not for navigating the ups and downs of the stock market. Two powerful emotions, fear and greed, are your portfolio's worst enemies. Let's talk about greed first. When the market is soaring and everyone is talking about how much money they're making, the fear of missing out, or FOMO, kicks in. Greed tells you to jump on the bandwagon, to buy high because you think it will go even higher. You see a stock that's already shot up 200% and think, I want a piece of that. So you buy at the peak, right before it all comes crashing down. Then there's fear. When the market takes a nosedive and headlines are screaming, market crash, fear takes over. Your natural instinct is to run for the hills, to sell everything to stop the bleeding. So, you sell at the bottom, locking in your losses. You buy high out of greed and sell low out of fear. This is the exact opposite of what you should be doing. Successful investors are calm and rational. They buy when others are fearful and are cautious when others are greedy. Taming your emotions is one of the hardest but most crucial skills you can develop as an investor. Another classic mistake is chasing hype and trends. Every so often, a hot, new investment comes along. It could be a trendy tech stock, a new cryptocurrency, or some other must-have asset that everyone is talking about. Social media and the news are buzzing with stories of people getting rich overnight. It's incredibly tempting to want to get in on the action. The problem is, by the time you hear about it, the smart money has likely already been made. People who chase hype are often the last ones to the party. They buy in without doing any real research, purely based on the excitement and the hope of quick profits. This is a recipe for disaster. These hyped-up assets often have no solid foundation, and their prices are driven by speculation, not value. When the hype dies down, the price plummets, and those who jumped in late are left holding the bag. Instead of chasing trends, focus on finding solid, quality investments with long-term potential. Let's move on to another portfolio killer, poor risk management. You've probably heard the saying, don't put all your eggs in one basket. This is the core principle of diversification, and ignoring it is a massive mistake. Some people get so convinced that a single stock or a single cryptocurrency is the one foot that they pour their entire life savings into it. They believe it's their one-way ticket to wealth. But what happens if they're wrong? What if that company goes bankrupt or that crypto project fails? They could lose everything. That's an unacceptable risk. Proper risk management means spreading your money across different types of investments, different industries, and even different countries. This way, if one of your investments performs poorly, you have others to balance it out. It won't completely eliminate risk, but it will protect you from catastrophic losses. A good rule of thumb is to never invest more in a single position than you can afford to lose. Finally, the last mistake we'll cover today is investing without a clear plan. What are your financial goals? Are you saving for retirement in 30 years, a down payment on a house in 5 years, or something else? Your investment strategy should be tailored to your goals and your timeline. Without a plan, you're just drifting. You might make random trades, hold on to losers for too long, or sell winners too early. A good investment plan should outline your goals, your risk tolerance, and your strategy for buying and selling. It's your roadmap. It helps you stay focused during market volatility and prevents you from making impulsive decisions based on emotion or market noise. Take the time to sit down and write out your plan. It doesn't have to be complicated, but it needs to exist. It will be your guide on your investment journey. So there you have it, the first set of major mistakes that cause people to lose money. To recap, lack of knowledge, emotional investing, chasing hype, poor risk management, and having no plan. By understanding these pitfalls, you're already one step ahead of the crowd. Thanks so much for watching part 1 of our series. If you found this helpful, please hit that like button. And subscribe so you don't miss part 2, where we'll cover even more ways to protect and grow your money. See you in the next video.